The San Diego real estate market in the end of summer 25 is at a turning point. Inventory surging, buyer momentum stalling, prices starting to slip a little bit. But don't just let that surface stat fool you, because what's happening under the hood actually is telling a bit of a bigger story. So whether you're buying, whether you're selling, or just watch from the sidelines, these three trends we're about to unveil could shape the rest of 2025. So let's get into that.
Yeah, no doubt. And we're going to talk a little bit about the economics of mortgage rates. Yay! I know everyone's real excited about that.
They are, though. Let's be honest.
But it's happening, and it could be changing the entire game right now.
All right, team. So because you took the time to click on this and you got this far already, I mean, we're already past the scroll mark, right? You're 3 seconds into this. I mean, thank you for hanging out.
Thanks for coming.
We
See you next
love
time.
to start with some data and some stats to help sprinkle some consciousness on the narrative. So detached inventory up 27%. Okay. Attached inventory up 37%.
More homes on the market.
More homes on the market, not a bad thing. It's the biggest supply jump I think we've actually seen in quite a while. And we've been purporting some positive numbers in inventory now for quite a while. And yet the new listings in the beginning of summer that are finally starting to purport actually dipped a little bit. I think this is what it means, gang. The backlog effect is real. I think that's what it means.
Sure.
I think homes that usually traditionally sold really quickly are now sitting a little bit longer. We're seeing that on our side.
Yeah.
You know, we're still getting good like foot traffic through. It's nothing like post-COVID numbers where you had a line down the street when the poor guy was installing the sign. Right. But you know, foot traffic though is staying alive. There's a pulse, there's a heartbeat, which means there's a lot of buyers that are being very strategic right now, as they should be. So good homes are actually sitting a little bit longer, taking a little longer to sell. I think days on market jumped up 22%.
Okay.
Which again is noteworthy. It's still at like a month and a couple days.
Right.
It's just hilarious.
Right.
Because I mean, if you look at like historically, a healthy market is usually at about 90 days of inventory.
Right.
So that absorption, we're still slighted on the seller side of that. Even though if you ask anybody right now on either side, I think it's slipping more to a buyer market, at least balanced at the very least. So we're officially in the price it right or stay put territory in this market.
Yeah, strategy becomes important in these times, right? Because the sentiment is, oh, well, I saw that one sign down my block.
Yeah.
Stay for a while. So homes aren't going fast. And that isn't necessarily what the data shows on whole. It's just that one spot, right? And we just had this conversation about different markets. Other markets are acting differently. Other markets are actually on the rise, moving more quickly, losing inventory. So this is a unique spot to San Diego right now.
So another stat, so list price to sales price. This is like the seller illusion is finally cracking a little bit. You know, there's an old methodology, as old as time, or at least since they've been tracking real estate data, where you take the last, 90 days of a sale inside of a geographic target neighborhood. And depending on if it was white hot or just average, you use that as a modicum to base your sales price off of. Well, what's happening right now is you're either pricing ahead of the market or you're sitting. I'll say that twice for posterity. You're either pricing ahead of the market and here's where it gets like, it's not even a fair fight. It becomes an exponential difference of you versus any of your other competition. Because if you price it right now, which is borrowing from the old efficacy, you end up having to chase the market a little bit. But if you price it just ahead of the market, all of a sudden you got like multiple offers the first weekend.
Yeah.
And then people are excited. Now they're coming toward you. You're compelling them versus you trying to convince them. Right. And if you're doing that, it almost kind of feels like, hey, what's the problem with the market right now? I got multiple offers after the first 2 weekends. What's the deal? Right. Versus having to price it where you think the market should be and then having to adjust down. Now that's not such a great look, because then when you get one offer and you're like, cool, I got an offer, but compared to what?
Yeah.
And now you're kind of negotiating it yourself. So sellers who priced like the 2022 market are having like a 2025 reality check.
Okay.
Is the issue right now. Price cuts are back. Bidding wars are very rare. This is not a crash. Let me be very clear about that. It's more of a recalibration of what we now know is true. And hopefully, Jer will share. So we got some good numbers coming our way, which could kick this in the pants a little bit.
Yeah.
But savvy buyers are using this softening to negotiate better terms.
Yeah. And we can combine that with what's going on in the interest rate environment. So, what's recently happened is generally bad economic data.
Yeah.
Right. And that tends to feel like, oh no. But in the mortgage world, that's, oh yeah.
Yeah.
Right. That's
Yeah.
Kool-Aid Man style. Like, let's bust through.
Yeah.
So, what we're seeing now is the bad economic data driving interest rates down a little bit. So, just recently, as of filming, we're looking at data from back in May where we're starting to see the interest rates trickle down again. And the indicator on the jobs cut and the revisions from the May and July data is actually making most folks think that the Fed is probably now going to start lowering rates in September, maybe October, maybe November. And now, what does that mean? That's going to have this buildup effect. So it doesn't mean wait till then, because that's kind of a hard play, because then you're not ahead of the game. You're chasing the game. But what it can mean is that we see indicators that rates are going to get a little bit better, which should hold against increased inventory, should hold against pricing because it's now more affordable. And all of that starts kind of building into itself, right? So you have, on one hand, you feel like there's a softening of real estate data, but if the interest rates are going down, that's going to bolster that quite a bit. That's the history that we've seen.
Right.
And so rather than looking at it and say prices are going down, if rates go down, they might actually hold prices up.
Oh, no question. And to your point, just to shine a big Hollywood light on that, there's no timing real estate, as the old adage goes. There's only time in real estate. And so I get it. You know, if you're in one of those camps where you're like, look, I totally would buy right now, but like the house that I want, I can't afford with where the rates are at right now. That's a real thing. And so you might have to actually wait for the rates to come down a little bit, assuming that they do. Because again, it's going to be a cloudy crystal ball, because as you have stated in this room on this channel many times before, by the way, smash that like button.
Oh,
hit the little bell, whatever the kids say. You would have also known that Jeremy has shared that in the overnight Fed funds rate, when you turn on the boob tube and it says rates have dropped, a lot of people think, oh, cool, mortgage rates have dropped. Not that easy, because what it really just means is that the amount of money that banks can borrow at has dropped, and that may or may not actually have a corollary effect to mortgage rates in a positive way. Sometimes when that cheap money, the short-term money goes down, it means long-term money actually goes up.
And so if you're interested, if you want to nerd out on this stuff like I do, you can watch the 10-year Treasury. And a little introductory to what that is, you can think of the 10-year Treasury as a thermostat for the economy.
Well said.
Okay. So the yields are going to drop when it's bad news. When the news is good, then we'll also see those yields rise. Now, how do they relate to mortgage rates? Well, you might think of that as the thermostat, where it's controlling. And so you'll see these rates rise in order to counteract good news versus bad news. Good news in the economy tends to increase rates, which is why with inflationary data, we're seeing rates stay high. If we see that economy start to go down, we'll see rates go down. And that can have a real impact, not only for those who are trying to buy, but those who already bought. This is a big group of people who already bought in this environment right now. They're ready to refinance. They're ready to get that payment down. And they've already grabbed their home at that price point. And so now they get to hustle down their payment, start stretching things out, get a better rate, and settle into what they were actually hoping for before rates hit this peak and stayed there.
And this is the hottest take in the entire episode, in my opinion, right now, because affordability is stuck at the bottom, right? So there's an old adage like, you know, the greatest transfer of wealth always occurs when the bold act, maybe when it's not even so obvious to act while everybody else is hesitating. So when affordability, and by the way, affordability, I can even cite that stat. It's in here. So the index right now is 25 for detached homes and it's 41 for attached. And you're talking about nerding out. There's a whole chart for that. You can Google affordability index. You can see what that might mean to you or to the whole economy writ large, et cetera. But what the takeaway is that the affordability being so low is actually keeping a cork in the bottle on prices.
Right.
And you might be like, I'm sorry. Have you been seeing the prices lately?
Right.
And I get that. But it's only when looked at through the lens of compared to what? Well, compared to if the rates weren't at high sixes, sevens.
Yeah.
If the rates were in low sixes right now, or even six, dare even say fives, what's going to give, right?
Yeah,
Everybody strategically sitting on the sidelines is going to be like, ooh, I got that. And then boom, next thing you know, prices are going to have a little modicum clip up. That's just how that works.
Yeah.
Right? So because of the fact that it's there, if you can afford to make the move right now, the timing of this could be perfect to where you actually get what you can get right now with the rates maybe being still where they're at, but you're locking in the price while the affordability is massively low before that affordability starts to pop back up again.
Right. And if you see rates drop 0.5%, 1%, depending on your loan size, you might see savings in the $500 range, $1,000 range. So you're actually getting your hands on something and then changing that economic profile later. In other words, a lower payment.
Because every 50, and this is not an exact science, but just kind of as a bogus rule of thumb, every $50 of monthly payment usually equates to about $10,000 of purchase power.
Yep.
Right. So that you just said $500.
Right.
You could do the math backwards on that really quick.
Yeah.
Like that's
it's
big,
1 million.
That's a big, gigantic jump.
Yeah, it really is.
Yeah.
Yeah, great. And so what we're seeing then is the people who are deciding to do it right now have the long-term future in mind, right? So, and again, to your point, and I think this is a really important point, if you can. Right? We can't, there's all these podcasts out there right now, like, get rich, buy 30 properties. Like, okay, let's put some perspective into this. Most people are having challenges affording property right now. But if you can get in and you feel like there's a downward pressure on interest rates, you know that sometime in your near future, you might end up with a lower monthly payment for that same property.
Yeah.
Would you?
Yeah.
That's the question you're asking yourself. Would you? And it may be time to look into that.
Speaking of time to look into that, so let's say you're in that camp. Let's play that out. Gang, let's just oversimplify. Let's say there's two divergent paths when it comes to financing, right? You've got like the standard stamped out, oh, here's my income, this is my down payment, this is what I can afford, and seen, right? Gotcha. You'd be able to get away with that strategy in a lot of other markets and do damn well for yourself. The game right now is, okay, are there any maybe out-of-the-box types way that I can structure this to where maybe I, air quote, can't afford it right now on paper, but if you do a little zig and a zag and a zig and a zag, maybe you can, and then you're locking in that price, and then if the rates do come down, cool, 6 months later, you refinance.
This is especially true for self-employed folks, people who have maybe variable income like commissions or bonuses, and maybe the last couple of years were a little weird, right? And you say, hey, but I still am interested in grabbing something right now. We've got ways to look at the numbers that are more indicative of your actual income than what hits your tax returns. And I think that's the way kind of around that is, hey, I'm ready to buy. I know I can afford it. Okay, well, let's look at how then we can develop a program that'll help you get into the home that you're interested in, even if it doesn't make sense down at your credit union or bank.
And that's on the mortgage planning side. On the real estate side, if there's 5 offers on a property in the first hour, it's really tough to negotiate terms, right? But if a home that you want's been sitting for a week, 2, 3, 4, right? Click, 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 click. You know that seller is being very price resistant. They're like, I don't really want to drop the price. But what is back on the table right now are concessions. If you fancily can actually go to the seller and be like, hey, check it. I get you. I like that price actually too. Yeah, market's being a little weird. Tell you what, I'll give you that price or something close to it. But what if you kick me back some cash on the backside of that price? And then you as the buyer use that cash to buy down the rate. Okay, well, now you're in a situation where you can afford the home. And as long as you can create quorum with the seller, absent or in a vacuum of other competition, you might just be able to pull that off before the prices go back up.
We're closing a loan on a transaction we're working on right now where we did just exactly that. Yeah. So it's a real strategy, and it's super effective.
So, gang, prices have plateaued. Good, bad, ugly, otherwise. But payments haven't. Okay? So interest rates, maybe they're going to get a little better. We hope. Our lips to God's will in the meantime. But the gates have been locked for a lot of would-be buyers for too long now, especially in that detached home category we talked about. So unless they drop precipitously, quickly or whatever, this is the game right now that's being played out in the front lines. So demand's going to stay cautious, even with homes more available, which means strategy right now is more important than ever before. How about that?
Yeah. And if you are a buyer, even just a dream buyer, a potential buyer, I'm begging you, get a plan in place. Do it now. There's no reason to wait. It doesn't help to put it off. You don't want to be in contract when you start working on numbers and schemes and tricks and all the stuff that we can do. You want to get together with someone right now and start putting that plan in place. Doesn't mean you pull credit. Doesn't mean you do an application. It just means put a plan in place with someone that you trust.
There it is, gang. So finish out the summer strong. We'll see you back here next month.